Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Give us just a moment here to go live on all the different platforms so we can get up and running and let everybody have a chance to tune in. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. Definitely appreciate it. You can also drop any questions you have in the chat as we go through the presentation here. But looks like we're live on all the platforms, so we'll go ahead and get started. So we'll take the chat off the screen, but go ahead and keep dropping comments and questions there in the chat. All right. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. And we're a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through an in-depth loan officer training topic. And tonight's going to be a great one, which is how to structure first-time home buyer loans. So definitely some misconceptions out there, and definitely something that, again, this last couple weeks we've been taking it kind of back to the basics. So this goes right along with that. So with that being said, Jose, I will let you go ahead and take over and get into your presentation. And if you have any questions, you can drop them in the chat there, and Jose would be happy to answer them after.
How's everybody doing tonight? Thank you for joining us for tonight's training on how to structure first-time home buyer loans. So what we're going to break down today is break through some barriers on the misconceptions that we have about what are first-time home buyers, who's eligible for all these great programs out there. Um, so let's jump right into it because all the information is in the presentation. So first, let's discuss what exactly is a first-time home buyer. The literal, definition is a borrower who has not owned a property in the last 3 years. That's the critical component there, because many people are under the impression that a borrower to be a first-time home buyer could never have owned a property, and that's just not so. That's why in the loan application, there's one of the questions there that asks, have you owned a property in the last 3 years? Yes or no? If you did, what type of property did you own and who did you own it with, right? So that's how we establish if the borrower is a first time home buyer. Now, prior home ownership is acceptable as long as more than 3 years have elapsed since the borrower came off title. Now, it's essential to note any first time home buyer option out there is going to be for primary residences only, no second homes, and definitely no investment property. Now, it's very important to note that the multitude of first time home buyer programs out there have been created to help families of all income ranges achieve the dream of home ownership. You have the first time home buyer programs that are just for first time home buyers. Then you have the first time home buyer programs that have income limitations. And then you have affordable option loan programs that are perfect for first time home buyers. Right now, that's a lot of what we're going to concentrate on here, because the first time home buyer programs that are income based, those that offer different types of forgivable second mortgages, some in large amounts, tend to be very limited in scope, which I'm going to break down in a minute. But what we're trying to get at here is that a first time home buyer is at a disadvantage, right? And that's really what we want to explain here is that first time home buyers usually at a disadvantage because they are not selling a property that has built up equity, right? So the first time home buyer is going to have to save the money for their down payment and their closing costs. I mean, yes, mind you, they may get some gift, they may get some seller credit and other different types of methods to try to garner up your down payment and all the funds you need basically for the cash to close. But the first time home buyer, like I was mentioning, is at the disadvantage because they don't have that home they're selling that maybe they've built up 50, 60, 70, $80,000 in equity. Now they're going to sell that, that a buyer would sell that property and have that money to put down maybe 10, 20, 30%, which is a totally different situation than if you're basically saving up every dime that you can scrounge up just so that you can put the down payment. And it becomes a little bit more difficult in some markets with really tight inventory that have high prices, where you have markets out there where your entry level home is $500,000, $600,000, $700,000 for just a standard 3-bedroom, 2-bathroom, 12 to 14, 1,500 square foot home, right? So just imagine that's a lot of saving up that you got to do for down payment, and closing costs could be $20,000, $30,000, $40,000 just to try to come in with the minimum down payment. So what we're trying to achieve here is offer strategies, not just programs, right? Because I don't want to really concentrate on programs. I want to concentrate on strategies to help first-time home buyers get into a home. So that's why we're talking about how to structure first-time home buyer loans. Loans for a person buying their first home that has most likely limited resources and is looking for all of the different ways so they can get assistance with the cash to close. So let's discuss the true first-time home buyer program options, right? So the true Fannie and Freddie Mac first-time home buyer allows for as little as 3% down payment and does not have any income limitations. That's really what I was referring to in that prior slide there. All you got to do is be a first-time home buyer and you can come in with that 3% down. Now, that doesn't mean that there aren't 3% down options for non-first-time home buyers, but I'm getting ahead of myself there. That's in the next slide. Now, one of the key components of a first-time home buyer loan, this is what makes them special, this is what makes the 3% down first-time home buyer loan special, is that it can be combined with community seconds up to 105% CLTV. All right, there are different sources for the community seconds. Could be an employer offering it, could be a municipality offering it. You can definitely check with your AEs regarding these community seconds, because we do have investors that work with community seconds, and they will be able to direct us to the community second that would be applicable for that loan. But in order to be able to go that route, it has to be a true first-time home buyer, not having owned a home in the last 3 years. Now, please note that the maximum DTI and minimum credit score is really going to be determined by your automated underwriting findings, whether you use DU, which is for Fannie Mae, or whether you use LP, which is for Freddie Mac. However, the matrix lists 620 as the minimum credit score for the conventional loan. But please note, don't think just because the borrower has a 620 that they're going to qualify, because you do have to run that through automated underwriting. Now, there are municipal programs out there for first-time home buyers, but these programs are localized in nature, and they tend to limit their assistance to the city, county, or state where the borrower resides. The loan originator and the loan originator's employer both need to be approved to offer the program. The programs are sometimes difficult to fund because they're dependent on funding availability. If the program doesn't have any funds at the moment, you have to wait to be able to close the loan. And on these types of municipal programs, also the assistance is based on income, with the lowest income earners qualifying for the most assistance. So I bring these municipal programs up only because I'm sure you're thinking about them, but they are usually not going to be the method that your borrower will be able to use to close on a home. I'm not saying they're not out there, they don't work, but they do have a lot of limitations and restrictions like I have mentioned here. So usually what you're going to have is the borrower is going to do a true 3% down first time home buyer program, maybe with a community second, or they're going to go with programs that benefit first time home buyers uh, due to their low down payment. And some of these would be these programs I'm talking about do not require the borrower to be a first time home buyer, but due to their low down payment, reduced interest rates, and reduced PMI or low credit score requirements, they are perfectly suited for first time home buyers. We're talking about, for example, Fannie Mae's Home Ready, which has a 97% LTV, 3% down payment. But for this program, just like for the Freddie Mac Home Possible program, which is the sister program of the Fannie Mae Home Ready, same LTV, both of these programs require the income to be at 80% or less than the HUD area median income for that census tract, unless the property is in a low to moderate income census tract or in a minority census tract or in a disaster affected area. You would only find that out once you run the address through the geocoder, either the Freddie Mac geocoder for Home Possible or the Fannie Mae geocoder for Home Ready, and then you'll get what the HUD median income is, what 80% of the HUD median income is, and if it is a minority census tract, low to moderate census tract, or if it is a disaster area. Now, FHA is another very popular program that benefits first time home buyers because FHA provides a 3% down option, 3.5% down payment option, and most importantly, with more lenient credit and mortgage insurance requirements. So let's break down each of these options right now. So I put there the important points to consider for the Fannie Mae Home Ready option. So what's pretty cool about that is you got the 1 unit 97% LTV, 2 to 4 units 95% LTV, double wide manufactured homes 97% LTV, warrantable condos 97% LTV, as well as modular homes 97% LTV. Now, a modular home is not a manufactured home. Modular home is a site built home. It's just that all of the individual pieces are partially assembled in a factory. Maybe you have walls with electrical and plumbing already run inside as part of the wall itself. Then they just put it together, connect some brackets there, and you have the home. You may see those also when you see like commercial properties with like the poles that are holding up a wall, and then they bracket them together, and in 2 to 3 weeks they have it built, which is the benefit of the modular home, but it's a site built home. Now, please note that the 2 to 4 unit property purchase under this program does require a minimum 3% contribution from the borrower's personal funds versus the 1 unit that doesn't have any requirement. It's a 3% down payment technically, but if you get different contributions from different places, there is no minimum funds contribution from the borrower. Again, like I mentioned, the income is limited to 80% of the area median income, unless it falls into the exceptions. And then I have there the URL for the AMI lookup for Fannie Mae. Now, this program does allow gifts, grants, community seconds, and up to 3% interested party contribution for LTVs between 90.01 to 97%. Home buyer education is required for this program when the borrower is a first time home buyer. However, like I mentioned, this program is not limited to first time home buyers like the regular 3% down option I mentioned first, which is a true first time home buyer because it accepts all income ranges regardless of location, minority, disaster. None of that matters. All that matters is for the first option that you are a true first time home buyer. Now, this one, you do not have to be a first time home buyer, but you do have the income restrictions. Now, the Freddie Mac home possible option. Now, let me back up a second. Why would you choose one over the other? You got to look at the guidelines a little bit. There are some slight differences in the two. So that's why you would do it. Like, for example, it's when you're looking at Freddie and Fanny, right? And one of the obvious differences is deferred student loans, right? Freddie Mac on a deferred student loan is 0.5% of the total balance is what they use to compute the monthly payment for DTI calculation purposes, right? So deferred says 0 on the credit report, but we can't put 0. We have to use 0.5% of the balance versus Fannie Mae that uses 1% of the balance. So that's a 100% difference. So, sometimes it's very common to have borrowers with 50, 60, 70, 80,000, $100,000 in student loans. If it's $100,000, that's a $500 a month difference in the DTI, right? In the payments when you're calculating the DTI, and that could make or break your deal. I mean, other than that, they're very similar in terms of the eligible properties, and all of the other components are all similar. The other component of Freddie Mac LP submission over Fannie Mae is going to be your self-employed borrowers. On the LP findings, it is basically pre-printed verbiage in the findings that if the borrower has been in business at least 5 years, if they've been self-employed, right, at least 5 years, then you will probably be able to go with a 1-year income finding as opposed to the 2-year. That's another reason why you're going to go LP. Fannie Mae does offer in DU that finding, but it's not, let's say, pre-printed in the findings. It's not an automatic. If the borrower is in business 5 years or more, you basically have to, that finding has to be offered to you in your results. So sometimes you get it, sometimes you don't. It's really going to depend on the risk factor of the file. And when the algorithm analyzes the risk, if it thinks the risk is low, DU may give you the 1-year findings on a borrower who's been in business less than 5 years. You're not going to know until you submit it. But those would be the two main reasons why you would use Freddie Mac over Fannie Mae. Now, another reason may be, and we see this happen all the time as well, you submit to DU, you don't get your approved eligible, you submit to LP, you do, and LP is actually called an accept, and vice versa. You submit to LP, you don't get your accept, which is your approval, but then you submit to DU and you do. So it's up to the algorithm because they're separate algorithm, separate data. So these two are conventional. Now, one thing before I go into the last slide and talk about FHA is very important when you're out there in the real estate market, assisting your borrowers with pre-approvals. Please know that in some markets, in the tighter real estate markets where inventory is really tight, there seem to be preconceived notions regarding conventional loans and FHA loans, and for a lot of reasons, many of them possibly not valid. the listing agents tend to have a preference for conventionally financed offers versus FHA financed offers, right? So keep that in mind. You always want to discuss with your realtor partners what it is that they're looking for, what it is that's going to be needed in order to help the borrower land that deal, right? No sense pre-approving them for something that then they're just throwing out offers and nobody wants to accept it. So that's really important to note because both of these options are going to be conventional, right? Conventional finance offers and may allow your borrower to be more competitive, especially remember if you're not getting any, asking for any seller contribution. That's another very important deal when you're negotiating. Now, our last option, which is the one that is more readily known for first time home buyers or among first time home buyers, is FHA. Now, here's where I'm clearing up some more misconceptions, right? Because FHA is not for first time home buyer. I mean, I don't know how many times I can count, more than I can count, let's put it that way, where I've been asked about, hey, I'm a first time home buyer and I want to take advantage of FHA, right? And then you got to back them up and say, well, great, I can help you with an FHA loan, but just want to let you know it's not for a first time home buyer. It's for a primary residence only. And usually it's for your only home, right? That's not saying you can't get an FHA loan if you have another, let's say a conventional loan already. But if you have an FHA loan already, it's going to be tough to get another FHA loan unless you meet the requirements of usually the property has to be a certain distance away from the existing FHA loan, or the family has to have grown where you need a larger, much larger home so you could document that. So there's a lot of different ways you could try to get around that. But the main point to note here is that FHA is not for first time home buyers. It's mainly for a primary residence. But why do first time home buyers look so much to FHA loans, right, as their go to? And, it's mainly going to be about income and about credit, right? And obviously low down payment, right? Max LTV of 96.5 down to a 580 credit score, meaning 3.5% down payment with a credit score as low as 580. Now, if the credit score does drop below 580 and down to a 500, we do have options up to 90% LTV. So 90, 10% down minimum would be required if the credit score is below 580, but we have options, right? I mean, that's definitely not something that you could do with a conventional loan. The other important note on FHA loans is that the mortgage insurance is based on a factor of 0.55% of the loan amount divided by 12 months, because 12 months of the year. That's going to give you your monthly mortgage insurance payment. And it's not based on the borrower's credit score. Now, that's real important, right? Because you have that borrower with a 620, for example, and you're thinking, oh, man, no, that borrower wants to do conventional 3% down because eventually down the road they want to get rid of the mortgage insurance. Okay, I mean, sounds good in theory until you set your file up and try to get an approval at a 97% for that 620 borrower. There's a good probability you're not going to get the approval for that 620 borrower from automated underwriting. And then if you do get that AUS approval at your 620, then you got to get mortgage insurance. And the mortgage insurance on conventional loans, for example, is based on the credit score. The lower the credit score, the higher the cost on the mortgage insurance. And that's a big negative, because you could get a borrower with a 650 score, perfectly acceptable for FHA, maybe a $200,000 loan where you're going to pay, what would that be? Like $110 a month in mortgage insurance, I think, for a $200,000 loan, FHA, versus conventional, which could be, 300, 350, $380, if or more, if you're trying to get that 97% or that 95% MI coverage with a 650 score. So then and on top of that, the rate is going to be lower for FHA than conventional on that same credit score borrower, because at a 650, 660, in those ranges, you don't really get any loan level price adjustments on FHA, but you definitely, anything below a 740 on a conventional loan, you start getting loan level price adjustments for the lower score. So then that borrower that's thinking, yeah, but I want to get rid of the MI, man, you know, how many years is it going to take you to get rid of that MI? If you do get it, how much more are you paying in principal and interest, and or basically in interest and in mortgage insurance, just for the benefit of maybe trying to get rid of that mortgage insurance? There's a good probability you may sell the home or refinance out of that loan because your credit score got better and the rates got lower than you would getting rid of the mortgage insurance on that loan, because you need to get to an 80% loan to value or less with no missed payments. So you really got to break it down for your borrowers well, and consult them. You're the licensee, you're the expert. You have to be able to consult them in all of these matters. Another point to consider here: 1 to 4 unit properties all have the same pricing on an FHA loan. So this is especially important for our first-time home buyer that wants to also be a house hacker, because this may be your only chance to do that, right? At a 3.5% down payment, for example, and on the conventional at a 5% down payment. But this is awesome, because then down the road, once you are in a position to get that second property, you can then turn this property into a full rental. But in the meantime, you're getting rental income from the other 1, 2, or 3 units that you may have, depending if you're in a duplex, triplex, or fourplex. And most importantly for the FHA loans is that they can be combined with down payment assistance options for the maximum benefit of first-time homebuyers. Remember, we're talking about first-time homebuyers are usually going to have limited resources because they have to save up every dime, save up all the money to be able to come up with the cash to close requirements. So definitely, if we can do a low down payment option like FHA and then combine that with down payment assistance as well. We recently went over those options. And we have down payment. We have down payment assistance of 3.5% of the sales price, 5% of the sales price, and then we even have what we call closing cost assistance, 3%, 4%, or 5%. And on the down payment assistance, we have both forgivable option, which no payment is required. That's the free money option, right? That's the aphrodisiac. And then we have the repayable option. And the difference between the two, besides one being free basically and the other one you got to pay back, is the interest rate, because nothing is really free, right? They built in a cost somewhere there, and the cost is that the forgivable option with down payment assistance has usually a 1% or more higher interest rate at the same cost than the repayable option. So in your standard loan, you could have a difference in payment of a couple $100 with these home prices that we have now. So even if you're making a payment on that repayable second mortgage, that's a really small loan. It's 9.99%, amortized over 30 years with a balloon payment in 10 years. I mean, in 10 years, you got to pay it off. Chances are you've refinanced out of that loan by then anyhow, out of the FHA and the second mortgage, consolidated into a conventional loan at a lower rate. You got rid of the MI. That's really the best way to get rid of the MI when your credit goes up or when the equity of the property also goes up. But that's how you're going to get the maximum benefit. But in comparing the payment of the two, usually it's about $120, $130 combined lower net payment for the repayable option than the forgivable option after taking into consideration the payment on that second. And it could be that you don't qualify for that payment at the higher interest rate. And also considering the forgivable option to get the lowest cost, the interest rate differential is probably going to be more than 1%. Could be 1.25% to 1.5% between the rate you're going to get trying to pay the lowest cost for the forgivable option versus the rate that you're going to pay for the repayable option. And one final note here, I want to mention, I know we were talking about low down payment options, right? And I really haven't included USDA nor VA as in this presentation because they have additional restrictions that make them not available for everybody. Because here we're trying to help assist as many borrowers as possible because, as you know, the USDA loans, for example, are for rural areas only, and the property address has to fall within a USDA designated zone. So you would go to the USDA geocoder, plug in the property address, and see if the property uh, falls within those boundaries. And also for VA loans, the VA loans are only for our veterans or active military. So again, a limited group there, not like all of these other programs that are really open to a much wider spectrum of the population.
All right, thank you, Jose. Looks like we do have some questions that came in here. I think we'll pull them up on the screen here. So, first question is: do they still need to be under income limits if it's a minority, disaster, low income, or do these have exceptions?
Nope, those are the exceptions. The exceptions for the income limitations for these programs are exactly those. It's either a minority census tract, a low to moderate income census tract, or a designated disaster area. You'll find that out when you plug in the address in the geocoder, and it'll let you know right away. The verbiage will be right there, and you'll know what you need to do depending on your borrower's income.
All right, next question. If they're using a co borrower, does everyone have to be under the 80% rule?
Oh, absolutely. At that point, if you're using a co-borrower, you have to look at the combined income of the two, right? So you can't just get a borrower that's making $30,000 because they'll definitely qualify for every census tract in the United States at $30,000, but you're not going to get very many homes in all the different real estate markets. And then bring in $100,000 a year co-bar and now have $130,000 a year income. Yeah, they qualify now, but now they've been priced out or incomed out, I guess you could say, out of the area median income usually, because most areas I see out there like 60s, 70s, $80,000. I mean, there may be some of those high ritzy areas in some markets, but typically that's the range that you're going to see. That's the 80%.
All right, next question. FHA mortgage insurance never goes away unless refinanced, no matter what the LTV.
Nope. There's actually scenarios where you can eventually remove the FHA mortgage insurance. It is when the initial loan to value of the loan is 90% or less. So if you start at 90% or less, you are given the option down the road. And by down the road, I think if I remember reading this in the FHA handbook, it's something like 11 years down the road. And I think it's 78% LTV or less. And then they let you remove the mortgage insurance.
All right. Another question here. Does 30 and 60-day lates on credit cards create issues for closing if they still have a good score? A client has 740 middle score but low of 540 because of the lates.
Well, apparently there you're getting that's a credit report of a borrower where some of the bureaus, those lates are being reported to some of the bureaus and not others. That's why we have three credit bureaus. But at that point, you got to remember the following: unless the loan is manual underwriting, and the only manual underwriting options we really have available to us are FHA. You do have VA, I think USDA, but not conventional. We have non QM. So if you're dealing with a manually underwritten loan, then you'd have to see what the guidelines state and the underwriter's discretion, right? Uh, but on the majority of the cases, if it's an agency loan, right? FHA, USDA, VA, or conventional, that's what we call our agency loans. It's going to depend on automated underwriting, right? So that's why I mentioned in the beginning, for example, yeah, theoretically the matrix says 620 for conventional, but it's really going to be up to AUS, right? AUS is going to analyze the risk associated with the file, and credit is one of the risk factors. And then you have the income, right? The DTI, how long they've been working at that job, how long they've been working in general, how old is their credit, right? The depth of the credit, the age of the credit, and then see what happens. But I mean, if you have 60 and 90-day lates in there and all that kind of stuff, AUS is going to pick up on that. AUS is going to look at the credit history, not just the credit score. So you really won't know on that until you run it through automated underwriting and see what kind of findings you get. That's why at the mortgage calculator on our agency loans, we don't issue pre-qual letters. We issue pre-approval letters after we have thoroughly vetted the borrower with a complete loan application, full credit report, reviewing the income documents as applicable, reviewing the asset documents as applicable, and any other documentation that should be reviewed. Then submitting to automated underwriting, getting hopefully our approve eligible or our accept for LP, and then we issue our pre-approval letter.
Okay, that was the last question. So great topic there here today. Remember, we do this on Tuesdays, Wednesdays, and Thursday evenings at 7 p.m. Eastern. So we will be back here next week with some new topics. Yeah, no more questions. Okay, cool. All right. Well, thank you everybody for tuning in, and we will see you next Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training.